Well, hello folks, I'm L.A. Little and this is your weekly NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective. Each time we ask ourselves just one question: what happened last week? What does it tell us about the coming ones? We do a show every Sunday night, broadcast at or before 10 o'clock Eastern Time, archived on YouTube. It's under the channel L.A. Little if you want to subscribe. That way when content's pushed you'll be notified. I had a viewer ask a question over here on the forums having to do with the infomercials, and if you haven't used the forums you might want to check them out. You know, there's some good stuff in here. The only one you can't get to unless you're a subscriber is subscriber information, but if you do come in here, all these others are available to you. And here there was about the infomercials asking a question, and I haven't replied yet, but basically that reply is to say, you know, yeah, we can do what you're asking for, and he wanted these services and tools and promotions, you know, the infomercials to be available in one localized place so that he could take a look at them on his own time versus just in the show. So they're here. Just come to NeoTA TV, hover, and they'll show up there for you. Let's get started here with the show, what we got going on. And let's start with the numbers first. If we look at it last week, I told members last Sunday, I do a broadcast every Sunday, and I told them I was expecting some sort of a down action, and we got that across you know, most of these indexes last week. The only one that stood out was the Russell and NASDAQ up on the year, Dow and the S&P down on the year. I believe you're going to see a year where you get a lot of topsy-turvy up and down. I don't expect that to change, and Friday kind of confirmed that idea here in the markets. And what I mean by that, well, if we look at the daily chart to start with, we actually had a big push up on Thursday after the pull down, right? That push up had looked as if it was going to do one of these turnarounds like we've seen before so many times, right? And then the next day they get a huge push. Not to be, folks. This thing didn't want to go on Friday, and there's a number of reasons for that. We can talk about them as the show goes on here, but essentially, you know, this thing pushed down with about as much volume as the day it went up, and it actually touched the bottom in a number of these cases or got underneath them. In this case, it got almost to the bottom, not quite, but we did get under it elsewhere. And that suggests to me that probably what we're going to see is we're going to see this market try to test those lows again. Now that's not you know, the end of the world. If we flip over here to the weekly, you know, we could have some sort of an ABCD structure taking place to the upside. I mean, that's possible in this time frame. You know, we still have, actually it wasn't from here, let me redraw that. We still have an ABCD structure. No, actually it wasn't from here. The one on the weekly is this one, which is, you know, down and back up, and it's a large one. I was thinking more about the daily one where we had an ABCD structure here that never finished, right? So we still have that one that's in place, and on the weekly it could be putting in an ABCD structure, but you also could be sitting in another structure to the downside, which would take it back into these lows. So, you know, at this point, with the volumes as they were on Friday, and with what was a disappointing bar on Friday compared to Thursday, you know, and you look forward as to what's happening with respect to the Federal Reserve, with respect to the announcements that's going to come on Wednesday, where it's expected that we're going to take away the patient language, and that's pretty much built in now, you know, the expectation of that. If we get that, I don't know how these markets are going to react. Now, Yellen has her press conference afterwards, so I'm sure she'll try to soothe the market after she takes away that language. How that market reacts and whether that market can push higher will be an interesting story. To get anything really going, right, as we talked about last week, you know, there's kind of an area right here that's going to be resistance, and then you're going to have it again up here. So there's plenty to resist a move back higher on the S&P 500. Now, if you want to take the glass half full versus half empty, you can push over to the stronger indexes and take a look at them. NDX being one of them. NDX has come back. It's come back into a bullish retest regenerate zone on the daily charts. And as it comes back into that, it's testing with about the same amount of volume. So it looks to me like, this is going to probably hold, but it's not written in stone yet. We've got the volumes here compared to there. It's a little bit more on the breakout bar. And so right now, this looks positive, not negative. If I look at it elsewhere, if I look at the NASDAQ looks positive as well. And let me get, we got the wrong one. Let's get the NASDAQ. If I look at the NASDAQ's coming back for a retest regenerate. Hasn't even gotten there on the daily chart. On the weekly chart, same thing. And I forgot to show you, and I'll do that one now. On the NDX, that one's back into the bullish retest regenerate zone. So there's a number of things here pointing to this market trying to hold at these levels and push higher again. If it doesn't, it's going to be a major tell, so that's one of the things we have to watch. Finally, if we take a look at the Russell also is trying to push higher. This came back in to do a retest regen again on this bullish formation, holds, spikes back up above it. If we look at it on the weekly, we also had came back into the retest regen again, and that was here. As it came in and did the test, it held and tried to push back higher. So we don't see negativity in the OTC stocks, and I'm talking about the NASDAQ, the NDX, and the Russell. What we do see it in is the listed issues, and I didn't show the Dow, but the Dow actually has that same issue. It's down here trading back below that prior swing point high, which says it's sideways trend, which also is the case for this. This one's actually broken down to a bearish trend right now, breaking under another swing point low. But overall, the Dow looks just like the S&P. It's back underneath the prior bullish. Well, actually, it looks worse than the S&P, but it's back below this bullish retest regenerate zone. And one more bar down here kind of says it's for real. So this will be a big week for the Dow, for the S&P, and for the market in general. Why is it having such a hard time? Well, you don't have to travel very far to figure that out. And it's really the currencies. And the currencies as a result of what's happening in Europe with QE. Dollar soaring on the QE news, continues to soar. You can see it here on the daily. You can definitely see it on the weekly. Big spike up in volume. Big push up in the dollar against the euro. The euro itself has been getting hammered, just keeps going lower. This thing is pushing towards par. We're only at 102.92, folks. That was after this euro was trading as high as 150, and as recently as 6 months ago was trading at 135 or so. Here's the 135 area, 137 area. Within 6 months, we're down, and well, it's not 6 months, it's about 8 months probably if you take it all the way back. But we're down in the the land of Oz, so to speak, as we head for par in the euro. Big, huge decline in this currency. Of course, that pushes the indexes higher on the world market, in particular in Europe. So if we pull over the European market and pull up, let's take the DAX for example. Here's the weekly on the DAX, just keeps soaring higher. If we do the CAX, the weekly on it, you got the same situation on a weekly. Even the FTSE pushed in with higher prices, although it began to give it up and actually failed on a retest bullish retest regenerate. So different story here. Of course, the London market has a lot of the metals in it which are getting hurt as a result of QE and currency skyrocketing with respect to the dollar. But in general, the European markets, of course, are benefiting just like all the other markets that have had QE. In fact, if we look at, say, Japan, for example, you can see here with Japan breaking out 2 new highs, stretching higher. ABCD structure here, still not done. This one can stretch even higher. And that's a result of QE, straight, pure, simple. And it's actually the ABCD is even higher. But these things are driven by the currency devaluations that are taking place. And when you have that kind of push taking place in these markets, it's going to be hard to break down any of them, right? It's not like the NASDAQ, the S&P, and so forth are going to skyrocket because of the euro markets, pushing as high as they are, or because of the Nikkei. But they're certainly not going to be hurt overly by it, other than by the fact that the euro is putting a lot of pressure on the dollar higher, which is going to hurt earnings, and that is, of course, being felt. When I come back here in a few minutes, we'll look at a few more of the OX markets and a couple of things with the sectors, and take a look at those things. So I'll be right back.
Do you have retirement funds you want to keep invested, yet you constantly worry about a potential market crash? As LA says, you shouldn't worry about a crash until it's time. Through LA's extensive research, he has identified the key characteristics that are necessary for a market crash. In the 2008 crash, for example, our investors actually made money and avoided huge losses through LA's investment advice. Because the markets usually go up, our retirement service keeps you invested when risk is low and reduces your exposure when risks become elevated. There are 3 portfolios you can follow: aggressive, balanced, and conservative. It's a simple process at a reasonable cost that requires very little of your time. To learn more, go to our homepage, hover over Retirement Service, and click Get Started.
Okay, so welcome back, folks, here. One of the paradoxes of currency devaluations and quantitative easing in general is that it's not really shared fairly across all markets. For example, if we just look at the emerging markets, and that's the MSCI Emerging Market ETF, and if you look to see what's inside, that ETF, it really is about those countries, those markets outside of the BRICS. You remember the BRICS were kind of a popular theme for a while. Well, this is looking outside of those, and you can see in the Americas, in the Middle East, and then also, of course, in Asia. But, it's a fairly broad measure of performance across a good portion of the emerging markets around the world. And when you look at something like that, and then you look here to see what the index is doing, or the ETF is doing, this thing's in a world of hurt. You break a swing point low here, that leads to a continuation. Now you break this swing point low, that swing point low, this swing point low, and you're coming after this one. And that's a terrible breakdown on a broad measure of the world's emerging markets. And then if you pull it over, you got volume down here at the lows, volume at these lows. This thing is going to go test those lows again. And so from an emerging market standpoint, and if you pull this over and look at the monthly, for some, 4 or 5 years here, the world has gone nowhere with respect to emerging markets. These things cannot get out of their own way. Now, it's going to be ugly if this thing actually starts breaking these swing point lows. And it's going to come test them again, it looks like. It certainly is going to come test these 2. That's what we just looked at on the weekly. And then you got monthlies down below them here. And you do have volume down there in all cases. So emerging markets, tough shape. What are they telling us about the world? They're telling us the world is not nearly as good as it looks like, right? Why is it good? Quantitative easing in particular countries. And even though it has disruptions, it's creating enough juice to keep everything elevated, because those things that are elevated are in the major indexes that most of us follow versus these emerging markets. And the emerging markets are getting hammered as a result of it. And they can't get off, I mean, just look at the time frame. This goes back to QE. Yeah, we got a bump off QE, but this thing never could really recover. So emerging markets, to me, that's a negative, continues to be a negative, and a reflection of the failure, I believe, of QE from a broad perspective. But it's not just emerging markets, it's commodities. Commodities have been, devastated with these moves in the currencies. And you can see these are, just terribly lower trends right across the board, hammered lower day after day, week after week. This is a weekly. That's the grains, grains going down. If I pull over, I was going to grab the continuous. Here we go. Here's the continuous commodity index. You can see the same sort of thing going on here, just down, down, down. New lows being made day after day, week after week, month after month. These commodities in general, all across the board, hammered lower week after week. Here's gold, silver. Let's grab silver here. Gold going after the lows again, silver down there pressing on the lows. And then if you flip over and you look at some of the bonds, we already know that we got negative interest rates across Europe. Well, here's some investment grade corporate bonds struggling despite QE. We look at the municipal bonds. They don't look particularly good either. If I look at the high quality, let's look at the junk bonds. Here's the junk bonds starting to head back down again as well. I don't see anything outside of some of these particular equity markets doing well. And I didn't want to forget oil. Here's oil coming back last week down 10%, coming after the lows again. Folks, these disruptions are huge. They're becoming more exaggerated as we go forward. I don't know where they're going to end. All I know is I see on the charts a lot of, shall we say, indigestion taking place in a lot of different markets. And that looks like a recipe for a lot of continued, what I want to say, spiking, up and down kind of action that we've seen. A lot of jerky up and down. Okay, so that's pretty much a decent look at what we have here. No viewer questions tonight. If you want to ask questions, whether it be with respect to the markets, general theory, whatever it is, right? I'd be happy to take your questions. It's pretty easy if you just pop over to TATV. You can click on here, as a matter of fact. If you come into this area, you can see how to get a hold of me. You can send email and or text, either one, and I'll pick it up and do justice as well as I can with respect to whatever your questions are. If you're asking about stock, give me the time frame, the direction. That way I can probably help you a little bit better. I'll be right back after this. Let's take a look at the final thoughts. Well, from a final perspective here, final thoughts, one of the things I always try to do is keep in perspective, where the market is on the different time frames. And when I look at it, from the major and general market, qualified trends, resources, market trends, if you take a look at this, you can see the damage again that's been done on the short term, right? If we look at the short term, we're either bearish or we are sideways in all cases. And if we look at the short term across the major sectors, that's also the case. And so even though we could get some more damage in these areas that are still sideways, we have a number of these markets already in bearish mode on the short-term time frames. Now that's okay because that happens, right? That's kind of the normal ebb and flow. So in other words, when the market goes up and it falls back, if it falls back long enough and deep enough, you'll break some swing point lows and you'll create sideways trends, or you'll create bearish trends. And so, that's kind of the normal ebb and flow of the market as the market works its way higher. So it's to be expected. What's always concern is when you start seeing it on the longer term. And how does that happen? Well, it starts with the sectors, right? We come down here and we look at the sectors, and we've got a bearish one where you would expect it in the energy market. Discretionary is actually sideways, and that one's kind of interesting because I didn't think it was, but I guess it fell back far enough. And what do we got? A sideways here on the utilities. So, not that much. Most of them still bullish, and that's good. It's just that when you travel sideways long enough is when you have to start worrying. And if we look at these markets, the way larger declines occur is when markets travel sideways long enough that they set up swing point lows that can be broken on those longer term time frames. And so in this particular case, you got 6 bars past this low. That's going to print as a swing point low if we go one more week without breaking this area. That would give you 2 swing point lows down at the bottom, right, in that 2000 area on the S&P 500. And if the market were to break through that, that would then change trend on this time frame, just as we changed trend back here when we broke in October. You see how we went to sideways. Now that can be a good thing if it flips right back around and heads up, but if it doesn't, that's when it gets to be a problem, right? Because not only do you have a break here, you can actually start, if you look at the monthly chart, and I'll bring the monthly over, you can actually start setting up the same thing on the longer term time frame. For example, here we got a swing point low. This is obviously going to be a swing point low if we go 6 bars, and we're already bar 5 now. One more bar, so the rest of this month, the rest of April, then we would print 6 bars, and this would actualize to a swing point low. On the S&P, that's around 1810. So you can see to break on the long-term time frame is going to take a fairly good drop. In other words, another 200 points from here, 10%. Can it happen? Sure. Is it the end of the world if it does? No. It would take time to build out a top. Tops take time. But do you want to stick around for a 10% drop to see this? No, that's why you watch on the weeklies and you look to see how these are shaping up, and when the potential for something larger to break actualizes, all right, or that potential gets close enough to where it's going to actualize. And that's what we should be watching, and it's what you should be watching. Of course, I'll keep an eye on it. Members will hear about it first, the retirement service and so forth, but it is something, we have to be cognizant of. It's a little early to worry about it now, but it definitely is something that is out there and is to be looked at. So that's the current trends. That's where things are. That is tonight's weekly wrap. Appreciate you being there. You tell 10 friend, tell 2. I will be back again tomorrow. We'll do it all again after we get a day of trading under our belts. Have a great one. Take care, and I'll see you next time. Good night.